Hello and welcome back. Now that you know the basics, let's walk through the Mockmates Private Equity Investment Framework for consulting case interviews, step by step. And remember, our framework is designed to answer the core question: should our private equity client acquire the target company or not? Let's go. The first component of the framework is the market analysis. Before a private equity firm invests in a company, they first look closely at the market the company operates in. They ask, can this market support strong returns without exposing the firm to too much risk? To answer that question, we break the analysis into four main areas. First up, how big is this market and how fast is it growing? That's the first thing you'll want to analyze. Why? Private equity firms ultimately want to grow their company's profits. A bigger market means more opportunity for profit growth, and a growing market means more tailwind for profit growth. Pro tip: a general rule of thumb is that private equity firms see growth below 5% as weak, between 5 and 10% as mediocre, and above 10% as attractive. Next, turn your focus to the competitive landscape. You need to understand how tough the battlefield really is. Private equity firms favor calmer waters, markets where rivalry is not extreme, and high barriers to entry keep new players out. They also favor markets where no competitor holds too much power. In those markets, margins are less likely to get squeezed, and there's more room to grow market share. Third, take a look at the value chain. Markets aren't just shaped by direct competitors, they're also shaped by other players in the ecosystem. From suppliers upstream to distributors downstream. You want to understand who the key surrounding players are and who's calling the shots. When strong players control either end of the chain, they've got leverage to negotiate prices, push for better terms, or walk away entirely. That puts pressure on margins and raises the risk of unpleasant surprises. Last, you also want to look at external forces that could affect the market. From regulatory changes and technological disruption to geopolitics. You want to know, is this a stable playing field or one where the rules could change overnight? Private equity firms look for predictable markets, so their returns are driven by strategy, not by rolling dices. Once a PE firm understands the market, the next step is to evaluate the company itself. They want to know, is this a good company to own and the right horse to back? To answer this, we break the company analysis into three areas. First, look at the customers. Analyzing and surveying customers tells you a lot about the business. Private equity wants happy customers. That's a quality signal. And sticky customers. That creates predictability. Customers with growth potential. And, low concentration, so no single customer can break the business. Next, the company's positioning. You want to know how big a slice of the market they have today, their market share, and whether they've got an edge that can keep that slice safe over time. Private equity firms love companies that are out in front, with leading market positions and advantages competitors can't copy. These keep rivals at bay, protect margins, and make the business more resilient. Pro tip: in real PE due diligence, this topic is huge. Teams spend weeks analyzing competitive advantages. But in consulting case interviews, you'll rarely need to go deep here. Finally, historical performance. Look at the numbers: revenue trajectory, margin trends, volatility, red flags. The numbers reveal trends and risks, and a solid track record signals quality. Now, let's move to the third component of the framework: value creation opportunities. Private equity firms don't just buy a company and wait. They ask, how can we actively work to improve the business to increase its value before exit? We can break this down into three key areas. First up, organic growth levers. To hit their target returns, private equity firms need the business to grow. So, look for obvious growth areas that are achievable and high impact. Pro tip: keep the organic growth lever analysis in mind when you're doing the market analysis. Market analysis often reveals attractive segments, customer trends, and white space. That should feed directly into the organic growth strategy. Next, operational improvements. This is classic territory. Private equity firms are razor-focused on cost and efficiency, and they're always on the hunt for ways to trim the fat. So, look for low-hanging fruit to cut costs and improve margins. Last, look for M&A potential. Sometimes the fastest way to grow is to buy additional companies. Private equity firms look for smart acquisitions that can strengthen or expand their companies. So, look for potential targets, synergy opportunities, or markets with consolidation potential. Finally, let's move to the last part of the framework: the return potential. This is where everything comes together, and we ask the big question: can this deal deliver the numbers our PE client is targeting? We can break this into 3 parts. First, the financial outlook. Remember, private equity returns mostly come down to 2 things: how much cash the company generates during ownership, and how much it can sell for at exit compared to its entry value. We therefore need a business plan, a clear 3 to 5 year projection of revenue, costs, and profit. Second, the exit strategy. Private equity firms don't buy to hold forever. Most plan to sell the company in 4 to 6 years. So from day one, they're already thinking about how to get out. And the best deals come with multiple exit options. Maybe there are many potential strategic buyers, like competitors with strong synergies. It could be the kind of business that other financial firms would love to buy in a few years. Or maybe it has the right profile for an IPO. The more exit options, the lower the risk of getting stuck, and the better the odds of a competitive sales process and a high valuation at exit. Finally, the risk factors. You should always weigh the main risks before recommending an investment. The expected return on investment has to be high enough to justify those risks. Private equity firms want to stress test their base case assumptions to model downside scenarios, and they are particularly concerned about tail risks, the low probability but high impact events that can derail returns entirely. So that's it. Now you know Mockmate's core private equity investment framework. And remember, this is your starting point. You always need to adapt the framework to fit the specific case context. Now, hang on for 5 insider tips from former MBB consultants you really should know about when solving these cases.